Welcome back to Money and Life TV, everybody. How y'all doing out there? This is the channel where you can come to learn about finances, investing, and taxes. We are about to start part 2, the final part of helping you understand the 199A qualified business income deduction. Now, if you haven't seen the first part, make sure you go back and watch that video first. I'm going to leave links in the description section and in the comment section. It's very important you watch that first because in the first part of this series, it's going to help you understand the rules and the overall ideas behind this new 20% business tax deduction. After you've watched the first part of this series, come back to this video and we're going to look at some calculation examples on screen. This Excel document that I'm showing you on screen right now has 5 full step-by-step calculation examples. And once you go through these, and once we go through these, I think the rules part of it is going to make a lot more sense. It's hard to understand the rules by themselves. It's hard to understand the calculations by themselves. But once you know both, then this deduction starts to make sense. So that's how I recommend you learn it. So after filming this video and after watching it, after taking time to edit it, I realized there was points of clarification I needed to add. Now, I just want to make it very clear that this video is going to help you tremendously understand the deduction, but it's not going to take you all the way. I have to be brutally honest. This stuff is so technical, ladies and gentlemen, that the only way you're truly going to understand it and the best way to learn it is to do some self-study. You have to invest some time learning this stuff. I can't teach you this in 5 minutes, 10 minutes, 15 minutes. This is a subject that you need to invest some of your own time and your own self-study to learn. So I want to make that clear. I really think this video is going to help you a lot with the understanding of it, and so is part 1, but I don't want to misguide you or mislead you. You're still going to have to invest some of your own time to really understand this because I'm not here to BS you. But I think you guys will get a lot out of this video. I've included several sound bites and clarification tips throughout this video and some fun ones as well to keep you guys engaged. So I hope you enjoy it. Let's keep on moving forward. So I'm going to cover 3 examples with you on screen in this video, and 2 of them you can just look at for yourself, do some self-study, and then we'll go from there. So without further ado, let's not waste any time. Let's just go ahead and dive right into it. Let's go ahead and start with example number 1. In example 1, we're looking at a taxpayer when their income is below the QBI deduction phase-out ranges, which we discussed in the last video. Okay guys, Chipper has stopped me right here and he's told me if you don't take some time to clarify some of this stuff, you're gonna confuse the hell out of people, and we don't wanna do that. So throughout the video, as we look at these examples, I'm gonna be talking about this QBI income phase out. And what does that mean? Well, we're gonna be looking at every example in this video is gonna be based on a single filing status. So Chipper is gonna be our example, and he's a single filer. And so that his QBI phase out in terms of his taxable income begins at $157,500. So when I say his income is below the QBI income phase out, it means his income is less than $157,500. If I say his QBI income is in between the phase out, it means his income is between $157,500 and $207,500. If I say his QBI income is above the QBI phase out, it means his taxable income is above $207,500. So that's what I mean when I'm talking about QBI income phase out. And this chart shows it right here. Now, like I said, all the examples are going to be based on a single filer. I did that so for consistency, so you don't get confused between one filing status and the other. If you're married filing joint, there's no difference in the calculation. The only difference is that you have a higher QBI income phase out range. So in other words, your taxable income can be higher before this deduction starts to phase out for you. So if you're married filing joint, as you can see on the chart, your taxable income has to be hit above $315,000 before it even begins to phase out. Whereas if you're a single filer, once your taxable income hits $157,500, your deduction starts to become limited beyond that point. Let's continue. This taxpayer has no capital gains, and that's important. You're going to see why in example number 2. So here's the facts of this situation. Chipper operates as a sole proprietor. He files a Schedule C on his tax return. Chipper manufactures bird cages. His bird cages are not considered a specified service business, and that's because he's a manufacturer. He doesn't provide services. He makes and sells bird cages. Now, this is Chipper's only business, and we're going to discuss multiple businesses by the end of this video, but let's just focus on one business example at a time. So Chipper is single. He's not married because he's single and ready to mingle. His net qualified business income is nets to be $140,000 in this example. Chipper's taxable income before the QBI deduction is taken into account is $110,000. Chipper has zero, like I said, in net capital gains, so no capital gains here to report. A reminder, the 20% deduction for QBI is limited to the lesser of the net QBI or taxable income reduced by any capital gains but before the QBI deduction. So here's Chipper's taxable income. So net QBI is 140, taxable income is 110. So this is how, in this example, it's calculated. So because his taxable income is lower, 110 is lower than 140, we start with that. And it's very simple. We take the $110,000 and we multiply it by the 20%. So Chipper's QBI deduction in this example, in this very, very simple example, is $22,000 that he's going to report on 1040 page 2, line 9, which is right here, guys. And this is a draft of the new forms. Obviously, the new forms aren't fully released yet, but this is where you would expect this deduction to show up. So Chipper's taxable income would be reduced by $22,000 based on this example. So this is one of the easiest examples. Now they're gonna get harder as they go. They're gonna get more complicated, as you'll see.
You didn't think it was gonna be that easy, did you? You know, for a second there? Yeah, I kinda did. Silly rabbit.
So just real quick, I'm not gonna do the full walkthrough on example number 2. Example number 2 is just like example number 1. The only difference in this example is that Chipper does have some capital gains. So Chipper it's the same business income, but he has taxable gains of $8,000. So what we have to do is we have to reduce his taxable income by $10,000. And so when we do that, his net taxable income that is used for this QBI calculation is $102,000. So it's just the same rules once again. It's to do the calculation, you take the lesser of your qualified business income, 140, or the lesser of your taxable income after they're reduced for capital gains, which is $102,000. So same process. So once we reduce his taxable income by his net capital gains, this is the number we use, $102,000, because it's lower than the $140,000. I hope you guys are following me. I know this is a lot of information really quickly, but I'm going to try to get through this information as quickly as possible for you guys. Remember, you're going to have this whole document for free to download, and you can study all these for yourself. So it just changes the formula a little bit, as you can see. And his deduction in this example is going to come out to be $20,400. In example 3, we're looking at Chipper. Chipper's business is now a specified service trader business. If you remember from part 1, it matters big time whether or not you're in a specified service trader business. Now remember, in example 1 and 2, Chipper's income was below the QBI deduction phase-out of $157,500. So it didn't matter if he was in a specified service trader business or not, because his income, based on his filing status, was below $157,500. So like I said, it doesn't matter what kind of business he's in, as long as he's below that threshold, he's going to get the full 20% deduction, or likely to get the full 20% deduction. But now in example 3 that we're going to look at, where he is in a specified service business, Chipper operates as a sole proprietor. He files a Schedule C on his tax return. Chipper works as a doctor, so this is Dr. Chipper to your service. He's Dr. Dreamy. He renders medical services, and his business is considered a specified service business. Now, this is Chipper's only business, okay? This is his only business that he operates. His filing status is still single, but notice here, his net qualified business income is $225,000. And Chipper's taxable income before the QBI deduction now, in this example, is $200,000. Now, Chipper has no capital gains in this example, zero. So we don't have to worry about that. So as you guys know, the common rule is it's the lesser of your 20%. The 20% deduction is the lesser of your qualified business income or your taxable income reduced for any taxable gains. Well, once again, we're going to be looking at this $200,000 because it's less than the $225,000 of his net QBI. All right. What you're going to notice, ladies and gentlemen, what I want you to notice as you look at these examples, based on your filing status, based on your overall income, and based on the type of business you're in, it's going to change how you do the calculation. And that's what makes this deduction so complex. There are some similarities, but there's also some differences. So you have to really pay attention to this. And you're going to see that as you study each example. Because the purpose of this video is to really help you understand how this all works. And that's why I'm putting this together for you guys, because there's so many questions out there about this deduction. Guys, it took me months to learn this stuff. Months. And I do this stuff for a living. So imagine how complicated this can be for somebody who doesn't do accounting or taxes for a living. It's pretty challenging. So let's go ahead and go to the example now. Let's go for it here. Because Chipper's income, this $200,000, it's above the $157,000 range is where the phase in starts to come into play. So Chipper's income is $200,000 as taxable income. Is how much above the $157,500? It's $42,500 above the phase out range. Okay, so his deduction begins to phase out once he's over $157,500. And so you're going to see here, and hope you guys can read this okay. It says Chipper's taxable income is $42,500 above the phase out range. So as you guys can see, that's the calculation we just did. So Chipper's deduction phase out percentage is 85%, because 42. So I should mention here that the deduction for a single filer, for somebody who files single, it maxes out at $207,500. That's where this deduction would completely phase out if you're in a specified service, trade, or business, which in this example Chipper is. So between $207,500 and $157,500, that's a $50,000 range. And so once Chipper's income exceeds this $207,500, he gets no deduction whatsoever. And this is why it's important to go back and understand all those rules in the other video, because if you don't understand it, these calculations, like I said, won't make sense. As you guys can see here how the calculation plays out. So Chipper's deduction, and rewatch this video as much as you need to, guys, and study this worksheet. Chipper's deduction phase out percentage is 85% because $42,500 divided by $50,000, which is the spread of the phase out range for a single filer, is 85%. Okay, so we know his phase out range is 85%. So let's see how this is calculated. So thus the limited 199A deduction is calculated as follows. So we know his qualified business income is $225,000, right? Because that number, $225,000, is coming from right here. We know his phase out percentage is 85% because that number is coming from right here. So the amount of the phase out is $191,250. So what this does is it's going to reduce his qualified business income, and it's going to change how we look at things now. So the qualified business income of $225,000, now we subtract out the phase out amount of $191,250. So now it's basically revising his QBI deduction, or his QBI income. It's revising his QBI income at this point. So now he's got a new qualified business income of $33,750. So now his qualified business income deduction is calculated on this amount. So initially when we looked at this, we saw that his taxable income was lower than his QBI. But once we revise it, because his income is above these phase out limitations, his QBI, after it's reduced for the amount of the phase out, his revised QBI is now lower. The $33,750 is now obviously lower than his taxable or his taxable income up here. So that's why we now have to use this amount to calculate the 20% deduction on that. So now we take 20% times the $33,750, and Chipper's 199A deduction is now $6,750. I know that's a lot to follow, but it's going to serve you well to study these in your own time, and it's going to make a lot more sense. It's really hard to get this across in a video very clearly without you guys really knowing the rules and really studying these calculations for yourself. In each tab, I've included some of the limitations that we were talking about, like the income phase-out limitations. So you can see I'm not pulling these numbers out of thin air. They're just coming from the regs and the rules. Now let's move on to example 5. This is the final example I want to share with you in this video. And what we're going to do in example 5 is when a taxpayer, and when their income is over the QBI deduction phase-out ranges, and when they're in a non-specified service trade or business. So they're not in a service business, and their income is well over the deduction phase-out ranges. So what does that all mean? Well, when their income is over the QBI deduction phase-out, it basically means, if we scroll down here, it means their income is above these amounts. But now normally, if like I said recently, if they're in an SSB or a specified service business, their deduction would be, they would have no deduction at all at this point. They're out of luck. No chance of getting any sort of deduction. But because they're not in a specified service trade or business, because in this example, Chipper is, once again, he's a manufacturer. Chipper operates as a sole proprietor. He files a Schedule C on his tax return. He manufactures bird cages. Once again, his bird cages are not considered a specified service trade or business. And this is Chipper's only business. So let's come back down here. Because Chipper's not in a specified service business, he gets to apply some other rules that might allow him to take the deduction. So now we're looking at this box right here, where it says W-2 and unadjusted basis limitations phase in. So let me zoom in on this a little bit so you guys can see that. So there's two tests here. First, if the limit is the greater of 50% of W-2 wages or 25% of W-2 wages plus 2.5% of unadjusted basis. So take a good look at that, guys. Pause the video, and now let's go to the top and work our way down to see how this is all calculated. And this will make a lot more sense once you see it in calculation form. So let's go up to the top and read the facts for this example. Okay, so once again, Chipper's filing test is single. Chipper's net qualified business income is $290,000. And Chipper, in this example, pays wages of $80,000. Chipper owns $190,000 in assets within his business. Chipper's taxable income before the QBI deduction is $260,000. And Chipper has, to keep it a little bit more simple, we're going to say that he has no capital gains. Zero. All right, let's see how this deduction plays out. First, we need to do some calculations to figure out what the limitations are on Chipper's deduction because Chipper's income is so high, because his income is well above the phase-out range. So first, we're going to do the 50% of W-2 wages test. So we know Chipper paid $80,000 in wages, right? Because that number is coming from right here. So we do 50% of W-2 wages. So that's $40,000, right? 80,000 times 50% is 40,000. Now we need to look at test 2. Test 2 is 25% of W-2 wages, which is 80,000 times 25%, plus 2.5% of unadjusted basis in assets. So in this example, remember Chipper had $190,000 in assets within his business, okay? So we take 2.5% times that, which gives him $4,750. So we add up the 25% of wages paid and the 2.5% of unadjusted basis and assets, and we get $24,750. Now remember, we get to take the greater of for this first part, because down here, the rules say the limit is the greater of whichever one of these is higher. So obviously, if you pass math class, $40,000 is higher. So that's the number we're going to work with in this example. So let's go down to, this is step 1. Now let's come down to step 2 and let's figure this out. Now what we need to do is figure out what the max QBI deduction would be. So we know that Chipper's qualified business income is $290,000. And remember that $290,000 comes from up here, right there. So we take 20% of that. So 20% of $290,000 is $58,000, folks. So now we're going to take the lesser of the max qualified business income deduction or the 50% of wages. And we're taking the 50% of wages here because this was the greater of the numbers in step 1. If this test had come out higher, we would be using that example down here instead. But because of the $40,000 and if 50% of wages is higher, we're going to use that amount. So I want to make that clear. And the lesser of the $58,000 or the $40,000, which is less? $40,000 is less than $58,000, clearly. All right, that's step 2. Now we're going to go into step 3, and we're going to start to finalize this calculation. So that was step 2. Now let's go on to step 3, and we're getting close to being done with this calculation. Now what we need to do is we need to calculate the 20% max deduction based on Chipper's taxable income. Well, Chipper's taxable income we know is $260,000, and that number is coming from right here because that's what was given. Well, that's what I gave you guys as the example. That's Chipper's taxable income. So 20% of $260,000 is $52,000, right? So we know that $40,000 is less than $52,000, right? Our maximum QBI deduction in this example number 5, is $40,000. So what this means is that Chipper could reduce his taxable income with this qualified business income deduction by $40,000, and he's going to report that on line 9. All right, guys. Well, I just walked through a couple examples with you guys. The most complex example in this whole worksheet is actually example number 4. And you guys can see, you can walk through this example in your own time. You can pause the video. You can download this spreadsheet for yourself for free. Like I said, I'll link it up down below for you guys. And this will go through step by step by step. This is a 5-step calculation in this part. So that's why I don't want to cover it all on camera or on screen because it's just going to take too much time. But you guys can study that for yourself. So we've looked at an easy one. We've looked at when Chipper his income is below the phase-out ranges. We've looked at an example where Chipper's income is in example number 2, where it's below the phase-out ranges, and he has a little bit of capital gains, of how that changes the calculation a little bit. In example 3, we looked at when Chipper's income is between the income phase-out ranges, and he's in a specified service, trade, or business. And in example 5, we covered when Chipper is not in a specified service, trade, or business, and his income is over the phase-out amounts, and how these other deductions, how these other tests have to come into play when we have to look at the 50% of wages or 25% of wages plus 2.5% of on adjusted basis. Hopefully this stuff makes sense, guys. Remember, feel free to ask questions down below. I've done my best to explain this, but like I said, truly the best way to learn it now is to go back and study this stuff for yourself in your own time. Look at the Microsoft Word handout that I created for you for free. Read the rules, and then look at these examples and give yourself some time, and it's going to start to make more sense. Now, in the handout, or in this spreadsheet, I've included links for you guys if you want to learn more about this 199A deduction. There's a couple links to where I've pulled this information together. It doesn't show up here yet, but I'm going to have a link to the video for part 1, and I'm going to have a link for the Word document handout that for Dropbox that you can find in here as well. So just make sure you check out this link section of the worksheet. There's a lot of good information. Let's just talk real briefly about having multiple businesses, okay? So if you're a business owner, and this deduction is meant for business owners, as you guys know if you watched part number 1. If you have multiple businesses, you would have to do this calculation for every business you own, okay? So for every business you own, you would do this calculation. But there's also aggregation rules. So for some people, for some taxpayers, they have multiple businesses and their income is really high. So their income is like above, let's say they're married, filing joint, and their income is like $600,000. So there are ways to aggregate. There's an election that you can make on next year's tax return or the 2018 tax return that will allow you to aggregate the activities of all your qualified business income activities. And that may or may not give you a higher QBI deduction if you aggregate. Now, if you aggregate, to my understanding, once you elect to aggregate, you have to keep doing that going forward, and you can't change it. And this deduction, guys, is going to be in play for the next 10 years, or I won't say next 10 years, but it's supposed to be in play until the end of 2025. And at that point or beyond that, starting in 2026, I don't know if they're gonna scratch all this or not. I have no idea. All right, guys, I've probably talked your ear off at this point. So now it's time to hear from you guys. So in the comment section down below, let me know your thoughts about this new deduction. Let me know if you have any questions. I'm sure you're gonna have questions to run by me. If I can answer them, I will. As far as I know, these calculation examples I put in this video are correct. There's always a chance I can make mistakes. So, do not consider this to be legal or tax advice. None of this in this video is to be taken as legal or tax advice. Always do your own homework, do your own research, consult with an accountant in the area you live, if you want to learn more about this stuff. This video was made to help you guys understand how the deduction works. And I think one of the best ways to learn how it works is to actually work through the calculation examples. And so then you can look at your own business and say, okay, well, this is the activity I've got going on. These are the wages I pay. This is where I expect my taxable income to be for the year, to help you determine if your calculation is going to be as easy as in example 1 or 2, or if your calculation is going to be really complex, like in examples 3 and 4, or even 5. All right, everyone. Well, I'm going to end the video right here. Let me know what you guys think about all this stuff. I look forward to reading your comments. If you liked the video, make sure you leave me a like. It really helps me out. Share this information with a friend, especially if you have a friend who owns a business. This new tax deduction is going to save a lot of people a lot of money in taxes. On this channel, we help people like yourself become fiscally fit. So to join our community and not miss any of our future uploads, make sure you just hit that red subscribe button down below. Thank you so much, everybody, for hanging out with me here on YouTube. It's always a pleasure. It's always an honor. Hope you guys have a great week. Hope you all chill, and I'll see you in the next episode. And take this information and use it to live your life uncaged. Bye, guys. Peace.